Hi, welcome to a Newbie Guide to REITs Analysis, and in this chapter, we'll check out a few financial ratios and understand how we should examine these ratios. So this is an example of the typical presentation for a REIT and the key financial numbers that they present. So we go through the numbers one by one. The first and most important one, I think, is the aggregate leverage ratio, or some people call it the gearing ratio. So for investors in equities and stocks in general, there's a bit of a difference because for REITs, the definition is typically for leverage as debt over assets. Whereas typically, if you invest in companies and equities, gearing ratio is defined as debt over equity. So there's a bit of difference that need to be aware of. But in general, it's the same in both cases. You prefer the leverage to be as low as possible, right? So for REITs, typically they gear up to buy properties and they give you the net property income. So typically you want this number to be around 35% or so. In recent years, because of the low interest rate environment, a lot of the REITs have geared up to like 40%. And you see that now that there's a bit of interest rate hike and stuff, a lot of REITs are now scrambling to sell assets to lower their leverage. So, well, in Hong Kong actually, if you look at the REITs, the leverage ratio is just like 20+% actually. So this ratio is going to differ from country to country and jurisdiction to jurisdiction. But in Singapore, I guess it's best to keep this number around 35 to 36% for prudency. So the second number is the unencumbered properties as a percentage of total properties. So you want this number to be as high as possible. What this means actually is that for this case, when this REIT borrowed money from the banks, it did not have to secure the properties to the bank. So it gives this REIT a lot more flexibility, right? So that when there's a credit downturn and the banks feel not that safe lending anymore, the REIT can actually offer the bank the property as a collateral to obtain the funding. So having unencumbered properties in the first place will just give the REIT a lot more flexibility in the event that there's a credit downturn. The next number will be the ICR, or the interest coverage ratio. This is another measure of the financial health of the REIT. The first measure, which is the leverage, by definition is the debt over assets, right? So this is mainly a measure of the health according to the valuation of the properties. Whereas for the ICR, it's a measure of the health versus the cash flow that the REIT has. Because having a very expensive property doesn't really mean you have the cash flow to pay back your debt, right? So like for example in Singapore, you find a lot of cases of the very poor rich, right? So people have a lot of equity tied up in their property. They might not have the cash flow to pay back a lot of the debts and stuff, especially when interest go up. So this is another measure of how healthy the financials of the REIT is. The minimum that is generally viewed as minimum by the MAS and the banks would be 2.5 times. So you want this number to be as high as possible, right? So you find that in recent times when there's a big interest rate spike and interest costs soared, the ICR for a few REITs have dipped below 2.0, and now the REITs have to renegotiate with the lenders to loosen the covenants and the stuff. So having a high number to work off will be good in the first place. So for the leverage and the ICR ratios, you also have the adjusted version for both. And this is because of the existence of something called perpetuals, which is treated as a full equity according to accounting rules. But if you consider the fact that you have to pay coupons to the perp holders as well, so that's a bit of a debt as well, right? So if you consider perps as a hybrid debt, a mezzanine kind of a funding structure, then you have adjusted ratios to cover that for perps as well. So you will naturally expect that the ICR will go down once you include perps in consideration. And you see in this case it goes from 4.0 to 3.8. And similarly, if you include perps as quasi debt, then the leverage ratio will also go up. I think for the conservative investor, it's better to consider perps as a 50-50 basis, so 50% debt and 50% equity, and readjust your leverage ratios and ICR ratios to be more prudent. And if you're even more prudent and more conservative, just treat it as 100% debt, and you can derive your own numbers. So this is also another measure, which is a net debt to annualized EBITDA. So well, you can also add this number, but most people don't really add it too much because of the volatility in the EBITDA number. Something which is very important is the average tenure of debt. So this is 3.3 years in this case. So it's just the weighted average of the debt maturity, right? It's a bit difficult to say if you want this number to be long or short. Because a long WADM might not be a good thing because you have locked in your debt for a long period. Uh, or especially if interest rates are high and set to fall. Similarly, if you have a low WADM and interest rates are gonna rise, then that's not a good thing either. So so in considering the this number, you gotta consider the interest rate environment you're in, and therefore whether or not the long debt uh, at a fixed rate is something that you want. So this is also to do with the fixed rate. How much of your debt is a fixed and how much of it is floating? And of course, you have a high fixed rate debt, then if interest rates move up, you're not affected. But conversely, if you have a lot of fixed debt at a high interest rate and interest rates fall, then you don't benefit either. So there's pros and cons actually. This is the weighted average all-in debt cost, and that's quite simple to understand. For every tenure of debt, there's an interest rate locked in, and therefore this is the weighted average cost for all the debt that you have. And typically, if a REIT is rated by Moody's and S&P and stuff and Fitch, they will give a rating as well. Of course, a high rating would be good because for this case it's A3, so it's investment grade. So there's gonna be favored for bond fund managers who have a mandate to invest in investment grade bonds. So they talk about it over here as well. So this is a set of measures for the financial health that you can look through. So on the asset side of the balance sheet, you want to look at the WALE, which is the weighted average lease expiry. So typically you want to have for stability of the income, you want to have a long lease expiry, right? So you want a long WALE if you want more stability in your revenue. But of course, if you have a long WALE and interest and rents rise, then you don't benefit so much, right? So it's a pros and cons actually. Do you want stability or do you want the ability to capture upside in rents? Do you want stability versus protection against downside in rents? And you also have a single tenant buildings and multi-tenanted buildings, right? So whether a building is leased out to one guy or leased out to many guys, and the pros and cons of it. So do consider what actually you want in a REIT. Do you want stability or do you want growth in rental reversions, and so on and so forth? So the final number that I'm going to talk about is something which is not very much discussed at all in the risk community, but I think it's very important actually. It's the expense ratio for a REIT. So they don't really typically report it in the presentations and stuff. You have to go to the annual report and dig out the number. And typically you do it right by for me actually I do a search for the word expenses, and then I try to find this section that computes this number. If I'm not wrong, all REITs have to report this number in the annual report. It's just a matter of how they present it and where they present it. So don't take this 0.27 financial ratios as the guide, because it's going to vary from REIT to REIT presentation. Just do a search. It's going to be really troublesome, but it's probably good to start from the back of the annual report and go up, because this stuff is typically reported at the back of the annual report. So this is a ratio of the total expenses, including management fees, right, as a ratio of the total assets. And in general, I think personally, you want this number to be as low as possible, right? You don't really want to overpay for managers, management fee and performance fees, especially if the manager doesn't even perform in the first place, which is quite typical actually. I actually think a lot of REITs managers don't deserve the pay. So just check out this number, and you want this number to be as low as possible. You certainly don't want a case where the manager is just fleecing fees off you and while doing nothing but destroy value and capital. So take And maybe it's good if you have a portfolio of REITs, you just do an annual compilation of your total expense ratio and just sift out those REITs managers who feel charge you too much fees and yet do nothing and destroy all value for you. And for those who charge a low fee and does a bunch for you, hey man, go ahead and buy.